Wow, what a show we have today for you guys. We have Melody Wright on here. Me and Nathan have an awesome conversation with her, and it's something we're not used to hearing a lot of times, the real truth. Uh, Melody Wright's the third time coming on. Uh, Nathan, what are some of the takeaways that you have from this call that are amazing? I mean, my head's still
Holy
flashing.
smokes. She's always so much information having come on and it's fire hose. So if you're watching you tune in for sure. You don't want to miss it. But then it's okay if you play it back at like half speed or something like that,
Yep.
or go back and watch it a couple of times. We talked about insurance. We've got some notes over here. We talked about insurance and how insurance costs have just skyrocketed over the last few years, and that is really hurting people in
50%.
50%.
Holy
And so
God.
it's major
And
increases in
California being one of the biggest
insurance.
states because of that fires.
So something to be aware of. And
Yeah.
that's she's talking about like why that's affecting and how that's affecting home sales
Yep.
because people literally just can't afford it anymore. They're with the insurance and everything else. Talking about equity problems. We're talking about Zillow said that 53% of houses have lost more than 9.5% of value. And
Holy.
and I can tell you that's area specific. Experiencing that right now where we're having price drops in
Yeah.
certain areas and things. And so that's been a big difference as well.
Absolutely. And then we're talking about the fact that market reality, right? 50% of recent home sales have happened outside the MLS. So these aren't going
Right.
through the traditional people that you can look on, difficult MLS sites and get comp and stuff, which is hard to track. What's doing what in areas? Another thing
And
is
if
she
it's off
mentioned,
the MLS, is that seller finance or how is that being
yeah.
sold?
And
Yeah,
then
interesting.
welcome back is short sales. Holy goodness, what's happening here? So that's a really interesting feature. And the last part that we kind of dove into in this call is credit. People are not able to get loans anymore. The
Hmm.
refinance or buying has been a record, right? That their rejections are over 43%. So tune into the call. We talk about debt to income ratios, rental stuff, all kinds of stuff. But make sure
All
you tune
kinds of
in
stuff.
and see what Melody has to say. Welcome back to another Real Estate Note Show. I'm your host, Dave Putz. As always, alongside me, Mr. Nathan Turner.
Hey, hey.
Hey, what's up, my man? Um, things have been kind of been different. We know we've been saying that a lot lately, but I'm seeing a lot more non performers come through. I'm seeing some funds closing stuff. And for no
Hmm.
creators, I'm seeing that ability to create more notes has been shrinking as well. They're not able to create as much as we've
Yeah.
seen before in the past. So it's what have you been seeing as well in your on your email thread?
Yeah, it's all kinds of different things happening all at the same time and different almost conflicting information sometimes because you're right, there's restrictions coming in on people creating notes, but at the same time then I'm also getting reports that it's never been higher. Then we're seeing more and more seller finance notes than ever before. So I'm like, well, so can those things coexist? I suppose they can. I don't know.
Yeah.
So and it's interesting. And then same thing. I'm hearing from some people that delinquencies are rising. And then we talked to Sohail, our servicer, and he's saying that actually it's better than it has been in the past. And so very interesting. And I'm not exactly sure what to make of it. Uncertainty in our world tends to be good news, actually. So it's actually okay that it's not exactly clear. One of the beautiful things about notes is we can pivot and we can change directions very easily and very quickly. So we can adapt, and I think that's a lot of fun. And I think that's what we're going to see going forward. I'm curious
Yeah.
to have our guest on today and get her take as well.
Yeah, absolutely. I do. It is very weird right now with being able to do it, but we're seeing influx of more. But I'm really interested to see we're seeing delinquencies in car loans, which is one of the first triggers that goes. And then we're seeing things such as like people at their max capacity to afford anything. And what does
Yeah,
that
it's
mean?
right. And I agree. The car loan one seems to be kind of a canary in the coal mine. That's kind of a precursor to what else is going to be happening. So that's definitely one that, even though we're not involved in car loans at all, it's an indicator of what may be coming. And so that's interesting to kind of watch and see. Student loan debt, same thing.
Yep.
Watching those kind of things, credit card debt, watching those things come up, and
Yeah.
then how are those going to then translate to the mortgage world?
Absolutely. I'm seeing the credit cards being one of the big triggers of, hey, listen, if I can't, if my credit card is the highest ever been and household income is starting to shrink again, what does that mean for the industry in whole?
Mhm.
While we're talking to those people who were creating 15, 20 notes a month, we're now down to 10 to 12. And then on top of it, we're hearing from our REO friends that selling an asset 2 years ago was 10 days. Now we're 90 days, 120, sometimes even
Yeah.
more.
Yeah, it's taken much longer to get a deal done, which
Yeah.
is again foreign to us. Like usually you're selling a note and it's done in like a week, 10 days, we're done. But
Yeah.
yeah, it's taken longer.
Yeah. So, with that said, it we're we're gonna also be honest in this call. I know the people we've had our guest on before. We want to make sure that we're gonna be honest with what we've said in the past and say, listen, we were wrong for predicting things. At the same time as what could have been shifted. Maybe it wasn't wrong 100%. It just was the timing was wrong or something affected it.
Yeah.
We want to be honest with people that listen, we're guessing. Since 2020, we said this doesn't make sense. But why is it still working? Right?
Yeah. Yeah. And we're always looking to learn, and that's
Yeah.
why we do this show really, is so we can learn stuff from people that know
Yeah.
more than we do. And
Yeah.
it's been so cool to have that happen over the last few years. And
Yeah.
that's what we do. So
Yeah.
I'm fine being wrong.
Yeah. Absolutely.
We can make our predictions and who knows?
Yeah. Yep. Let's bring her in. Melody Wright. Thank you so much again. Third time on the show, but you're awesome information. You're a different world than we're in. Welcome back. Thank you so much for joining us.
Thank you for having me. It's my pleasure.
So let's start out. What have you been doing since we've last had you on the show? What changes have you made? What have you been exploring? Just a 10,000-foot level.
Yeah, I mean, it's in these transitions, it can be very difficult to tell what's
Mhm.
going on. And what I would say is, I find what Sahil says is fascinating, but not without precedent. And so let me start by saying, Dave, well, how I was wrong coming into the beginning of this year. We had such strong sales in December of last year. I thought we could push that through and actually have more transactions, which would mean more price discovery, because that is what had happened in the fall when rates started to come down before the Fed cut. Sorry, just have to mention that again. And then after the Fed cut, of course, rates went up again. And so I thought we would be able to keep that momentum because you could also see there was a lot of exuberance around the new administration. Everything was just like churning along. And then April, the tariff terror happens and everything just came to a screeching halt. The bond
Mhm.
market went absolutely bananas. Rates, were just, I mean, the bond market was selling off like crazy. And so the housing market died again. I mean, it died. I mean, when we say 2024 was the worst sales since 1995, and we've increased population by over 20%. I just don't think people they need to understand. Now, part of that I think is because it's in your space. And I have a little anecdote, don't let me forget. I want to tell you about that seller
Okay.
financing to your point about notes increasing or decreasing, which one. So anyway, so we get here and we just kind of skid to a stop. The summer was very lackluster, and I keep pushing, just come on. We just need more sales because what's happening to that median price is so firstly, I don't like to make predictions. I like to just talk about the path, but I've been forced to do it because certain people wouldn't debate me if I didn't have a forecast. And I can only look at the math, and what it tells me. And so yes, I was wrong in my prediction of home price decrease. But what's happened again this year is that because we had so few transactions, who's transacting is that top 1 to 10%. It's now more than 1%, not even 10%. And then anybody they can get in the door. The last one in the door with FHA, the builders are doing this, giving crazy incentives. They're about to get in trouble. There's been a big study out
Mhm.
about those seller concessions that they're not properly accounting for because they're doing an accounting trick.
Mhm.
And on the new home side, by the way, those prices have come down,
Mhm.
and that's before you take into consideration all the incentives, which is about 50,000 per home if you ask Lennar. And so the new home market has been chugging at a much faster clip than the existing home market. And when we last got results from them, that median price went below the 400 mark, and that was before their worst time of the season. Okay, that's going to come up here soon.
Mm-hmm.
Now we haven't had builder results for 2 months in a row because the government shut down, and so that is by census. So we have no idea what's going on in the market, but there are clues in the existing home market as to what's going. And this is a long-winded answer, but what I'm seeing under the covers in the existing home market is you're starting to see transactions increase in that below 250 price tier. We need more of that. We need more of your regular Joe and Jane transacting. So today we just got application numbers for mortgages, which is up, but that's a weekly series. Don't, you got to look at it more long term. But we definitely did see sales increase last month. We're now about 2,000 sales ahead of where we were last year. So if we keep pushing, we can just, because I think what you're seeing under the covers of those 85 markets that I track, a lot of those markets are already in correction territory, like twice as many. So about 31 of the 85 markets I track have year-over-year price declines. That's twice what it was this time last year. You just saw Zillow come out and say 53% of homes have lost value through their estimate at about 9.6%. I thought that was funny because I had said I think it's going to be 9%. But before the brakes kind of went on. And so anyway, we are seeing it correct in many places across the country. And so if we can keep pushing sales, then that's actually where we're going to start to see home price declines, in my opinion. So I can stop there, Dave, to see if there's anything you want to pull on, because that was a lot of words, and then I can go on to the rest about Sahil's point on the delinquency side.
Yeah, I think house sales is something none of us predicted, right? Nathan and I both talked about this, that it was just chugging along, and people are still in demand for this. And it just flattened, where it was almost a month turnaround, where it went from this is going well, and who you spoke to, it's like, whoa, it's going great, it's going great. And then when someone goes, no, it's flat, and you're like, who's right, who's wrong? And then within 2 weeks, you ask anyone, oh yeah, it flattened. It just was an overnight switch. It's like, well, the 30 days here, 15 days there. Now it's a 90-day. We've not sell anything. We're now bailing out. And then what hits then? Those people who are listening to us who do hard money lending. We'd love to see some feedback from you of what are you seeing in trying to sell these properties.
Yeah.
We're hearing from the people who are lending that hard money lending, saying, hey, anyone who is not able to make the balloon payment in 12 months, we're going to forgive the 18% or whatever the default rate is, just get our money. And it's been so amazing to see that. Nathan, any thoughts about that?
Yeah, it's the same kind of thing. And to your point, like you say, David, like we've got some properties for sale in California, and all year long, up until like 2 months ago, 3 months ago, it was just chugging along. Everything's going, everything's great. And then all of a sudden, like a light switch, we've got one property in Oakland, and it's just like nothing. And it just like nobody's coming to the open houses. Nobody's even looking at this. And it's insane. A month before that, we would have had competition on it. We would have had multiple bids. And then all of a sudden, literally nobody's even coming to the open house. So it's fascinating. And just like overnight, all of a sudden. And so that's been really interesting to see and watch. And we're not exactly sure why.
Yeah.
I would love to know the reason why, so that we can figure out how to.
Is it the fact that these people
go
can't get
around
loans?
it?
Is it
I don't know.
Debt has gone up? Is there cost of living? It can't go up that cost of living can't go up within a month, but we're curious. Do you know what could be triggering some of this change that so quickly?
So let me tell you the one time it can go up in a month, right? It's when you get your escrow notice.
And escrow will do it.
And May is when Californians, when you get that escrow analysis run every year. Okay. So think of that for perspective. And I saw it. I all of a sudden in my servicer advances, because, as a servicer, you have to advance out money for those property taxes and insurance. And what had happened, I think it was April, right around that April, May timeline. No, it was right in May that everybody got their insurance increase notice as well. And it didn't hit some of those escrow analysis, like in time for the escrow analysis. So my servicer advance went up exponentially of what I had to pay for insurance because everybody got their notice in California that their insurance was going up by 43%, even if they weren't in a fire zone. And so that definitely that's a time when in a month. Now, of course, all over the country, it's not like that. Sometimes you do it on the yearly basis. It just depends on the state. So that's when it could happen. But I mean, I couldn't believe what I was seeing in escrow notices. And again, this is like the third year in a row, though. And so when I was at a very large, the number 3 largest servicer in the country, they had done a review of their entire servicing book going back to 2020. And they said that insurance has increased across the book by 50%. That is insane.
Oh,
Wow.
And so people, they just can't afford these homes. And so the other thing that's an interesting phenomenon, right, is that and moving over to the delinquency side. Well, so let me stop with so the Fed just came out with its summary of consumer expectations, and they track expectations as well as actual results. And the mortgage refinance rejection rate is the highest they've ever had in that series. Now,
wow.
in February, it was at 41.7%. That was something I said at your conference. So it moderated after then, and then it just clocked another high. So I think it's around 43% right now. So people can't refi. They can't refi. And, and then it's in terms of purchase, they're not qualifying either. And a lot of times that's happening at the closing table when they look at that final insurance bill and they're like, negative. Like I can't do that, So moving over to the default side, what we saw in the last cycle as well is that FHA peaks early. So your specialty servicing, these are the people that have already been in trouble. Or maybe they've lost their job 18 months ago or 2 years ago or whatever. And so specialty servicing is actually going to peak before everybody else. FHA is going to peak. And then is when you start seeing degradation in your prime book. And that's what I'm starting to see right now in servicing is prime is starting its climb up. And then we see these layoff notices. Challenger came out and said October was the worst. October they'd seen, I can't remember. It's like always going back to the crisis, right? These days, the headlines, worse since 2008 or whatever.
Yeah.
But so layoffs just keep coming fast and furious. And, so there is people, despite what the administration says, despite what everyone wants to claim about the economy being great, it's terrible. I mean, and people, then you put a government shutdown on it. And so, the stock market's going out of control. There's a lot of reasons for that. If people have never read Mike Green or someone like that who talks about the passive flows from the 401ks and that's how this kind of like blind machine keeps driving the stock market up. But there's a little dent in that narrative now too. You're seeing all across mainstream media, they're talking about the AI bubble, which is something my colleagues have been talking about for years, but it's now picking up steam in mainstream media. And so I think what happened in April, guys, is that when the boomers saw that stock market crash, they saw it go back up, but they were also like, I don't feel so good. And I think that's the consumer as well. Like even with the stock market going up, they know what they can and can't buy. They know how constrained they are financially, and they are completely constrained. Now, we'll probably see a little bump in retail sales for November and things like that, because if you weren't getting a paycheck for how long you want, and we saw it here, like the day that everybody got paid, because we have a big VA hospital. Like I went to the mall, I was like, whoa, I haven't seen this in like 3 years, but it's going to be temporary because people just, they're losing their jobs and they just don't have the money to sustain. So, and I think what we're about to see is the prime book deteriorate. Now, FHA, because of those guardrails that went on October 1st, we will start to see material foreclosures come out of that population. And so, you'll definitely see the tick up in Q1. This takes a long time, as you guys know, because of the CFPB. But then by Q2, that's when all the time should run out, and we will start to see those. And we're already at, double-digit increases year over year for foreclosure starts and sales, which you guys know it only takes one in your neighborhood to make a real difference in things. And so this can happen very quickly. But I think the biggest thing is that access to credit has really been restricted, not
Yeah.
necessarily by the lenders
Yeah.
saying, but by just the fact that people can no longer qualify.
Hmm.
And is there any kind of thought of when that may change? I mean, it's tough. I I think it's credit card debt, groceries cost more, everything costs more. That I don't know if there's a light at the end of the tunnel for this, but I also don't see a influx of non-performing where things are good defaulted quickly. And the weird thing is there's tons of equity out there that I would think that these people will be able to sell their property, but then they can't qualify for a new home.
And
So,
then they're going
yeah,
from a 3% rate or a 2% rate all of a sudden up to
right,
a 6.5, 7.
right.
That's a lot of money every month.
A lot of money. It's a lot of money, but I honestly, I've talked about this before. I
Yeah.
think our picture of equity is problematic. I don't think that because of, people not reporting things to credit, private credit got in mortgage in a big way, and they're not reporting everything to credit.
Mhm.
And as we know, those payment deferrals are not recorded on public record. And so CoreLogic, Totality is not factoring those into their equity analysis. So and what I'm actually
Just real
saying,
quick,
if
so
I
for
don't,
those who may
go
not
ahead.
missed our last call, what is the payment deferrals and what does that mean?
So, as the workout to the forbearances, you could take those 18 months of payments and put them on the back of your loan. It's non-interest bearing, and it's paid off when you sell the home or ultimately pay off the loan, like the refinance. And the agencies made the decision not to record those. And so nobody knows they exist unless, like, the way you guys are going to know is when you get that payoff quote, it should have it on there. But if these things aren't recorded on public record, CoreLogic's not picking them up in their equity analysis, which is what everybody uses. And
Mhm.
then the Fed uses Experian for their household debt and credit paper. And I'm starting to notice that Experian just has a lot less, like if you look at credit reports, you'll see that there's a lot less items on an Experian credit report, like
Mhm.
negative items, than say maybe Equifax and the other. And so this is the thing, you don't have to report to all of them. In
Yeah.
fact, you don't have to report. And so I
Yeah.
think that's what's happening because the Fed showed 30 plus coming down a little bit last quarter. NBA didn't show that, like even in Black Knight's number. So it's like that's just weird.
Yeah.
So but
So you
anyway, so
think
the
that you
picture's
think the
just not
debt of the
clear.
household is higher than it's being reported, so
100%.
that the value,
Mhm.
like the old was that the Schuler test where it's that household income versus value of the property is not where we
That's
were in
shrinking.
07, 07, 08, but we're getting to
Yeah.
the point where it's unaffordable and it's displaying that.
Mhm.
Yeah. And you can go, so you can fact check me and go look at Fannie Mae DTI levels right now, debt to income levels. We are right at 2008 levels, around that 38% in
Wow.
the Fannie, in the prime book, in the prime book. We
Wow.
should never be at 38% in the prime book. Okay.
Mhm.
Yeah.
It's just, that's not sound lending. And so,
Interesting.
yeah, so I think again, there's just a ton of narrative. And so it makes it very confusing. And I think, Nate, as you say, when we're in those big transition periods, you are going to hear a lot of conflicting information.
Yeah. Yeah.
But where I would tell everybody to keep looking is at inventory. So what we've got going on right now in the existing home market is a lot of rage delisting. There were several stories this week about that where boomers didn't get the price they want, so they just delisted. But that inventory is still there, and come spring, it will
Mhm.
not be alone. And I think they think that it will be alone because so many people talk about the inventory shortage. And so I think a lot of people are going to be in for quite a surprise in the spring because they've just been convinced until we got an article in Bloomberg and an article in Wall Street Journal this week that, there was an inventory shortage. They would be able to get that price for their home. But both of those articles in the same week said, you need to consider lowering your price if you want to sell your home. And so that
Mhm.
message went out loud and clear
Wow.
in
Mhm.
anticipation of the spring selling season. And before that, 2 weeks ago, we got the message about the builders that they're in trouble. A couple of articles there. So I think the narrative has changed, and we're in that transition moment. And you're going to actually start to see FHA is going to start to flow through the system, but they may not get higher in delinquency. I hope that kind of
Yep.
makes sense. Like
Mhm.
whatever has been building up in the dam is going to flow through to foreclosure. And now we've entered the part of the cycle where Fannie and Freddie start to degrade, where your prime book starts to degrade, because your peak distress has really already hit that subprime borrower. And if you go back and look in history, you'll see that FHA definitely peaked almost a year before Fannie and Freddie.
Wow.
I think it was really a year and a half.
Are you,
So yeah.
are you seeing any
Huh.
changes with those people who have equity, like they did in 05, 06, taking second liens out and taking a hold of it? Or are you seeing people being smarter than they were in 05 and holding off on that? Are you seeing kind of numbers?
Yeah, I think people are taking it if they can qualify for it. I mean, I don't think anybody's being smarter in this cycle. I mean, I'm sure that there's probably people out there. I don't ever hear. I mean, some of the things I've seen in servicing already are absolutely bananas. Like 15 liens on one property. The like, and the servicer realizing that their investor's not in first position. And I mean, I'm seeing some nutty stuff where people like turned around and got a fake 2.2 million loan, right? On a fake, like they sold it to each other, so that the person could turn around and refi it and then go buy another property. So these are like little rings. There's a case I'm helping with down in Phoenix. I mean, no, hardly anybody got smarter. Probably just the people that got really burned in the GFC got smarter.
So I'm curious, like, there's been a couple of quote unquote solutions that have been kind of floating out there. So I don't even think it's worth talking about the 50-year mortgage. It's just such a not a great idea that I don't think that's going to take off. However, the portable mortgages, that is something we do in Canada, and that's actually what we did 3.5 years ago. We took our ultra low rate 1.75 and just transferred it to a different house. So we ported it to another
Never
property.
heard of being able to do that. Even that's amazing.
It's
Well,
not in the States, and it is in Canada.
Right.
However, the thing that I would hope that they do in the States, if this is something that goes forward, is we really did have to requalify. So it wasn't just we qualified before and now we just go ahead and just transfer it to another property. We had to requalify. We had to send in all of our same documents that we did as if it was a brand new mortgage. Had to prove the value of the second property, make sure there's enough equity, those kinds of things. Like it's a lot more complicated than maybe it initially sounds. Like and don't get me wrong, taking that rate for another 3 years has been fantastic. But I would hope that if that's something that's considered in the States, that they do it responsibly and make people requalify.
Yeah, I mean, the thing is, any solution is possible, right? But you would take down our securitization machine, and it would. I mean, and so that's a big
That's true. Yeah,
in the
yeah.
non-solution space. I'll call that our political. They can't even imagine doing something like that. But it would literally take down the securitization machine. You are signing that deed is your security instrument.
Right.
And so you would have to change all kinds of, rules within securitization. You'd have to buy it out of the pool more than likely. And then you would not have any certainty over reselling it into the pool at a certain rate. And so then that would add on the premium. And so your interest rates would probably have to be higher. So I'm all for it, Nate, but it would bring down the entire securitization machine in the US.
Huge thing.
And I'm all for that. I'm all for that. But that's unlikely.
And Nathan, when you
because-
did do that and the house value is higher, do they just increase the loan balance and redo the loan for 30 years?
So for us, the way it worked out was the home value was very, very similar.
Okay.
So I sold at 860, bought at 810. So we're right on par and, almost straight across. So it was a very relatively simple process, except for having to requalify. And that was the big challenge. And so, but it's a viable option, except for the securities thing, where then that creates all kinds of havoc.
So, Melody, with this being said, are you seeing markets that are still doing well?
I mean, what does well mean? Like,
That days of
y-
market aren't 90 plus days. That there's is there any markets where like,
yeah,
oh, because Texas and Florida right now, from we're hearing from the stats, is not doing well at all.
yeah. I mean, there's certain markets where there's definitely transactions happening, like Rochester, New York. They're still transacting there, like Indianapolis. They're still somewhat transacting. But I would say though, there's stuff just sitting and sitting and sitting. So there's a little bit of transaction, but no, I don't. There are not many markets that are just on fire now. For
Mm.
whatever reason, something was definitely going on in San Francisco. And what I've heard is that people were trying to offload their homes to like NVIDIA millionaires and things like that. And so I think you have markets where there's more motivated selling that makes it look like it might be relatively stronger, but then that it reaches a point and it just kind of like peters out. But there you see that, and I've come up with a new category called depressed selling, where sales are down year over year, but so are prices month over month and year over year. And I call motivated when sales are up and prices are down, because people are really motivated. But distressed, this is what we're seeing more and more of now, is where you get that foreclosure notice. Are you run out of your very last forbearance, and you have to turn and cut. And so what I do is I look, and this is the point I wanted to make. I take a sample of all the payoffs that I see in client books, and I go, look, okay, what happened? Did you sell? Did you refi? Whatever. So of this sample, I will tell you that more than 50% sold, but not through MLS this past
Mm.
month. And
Interesting.
yeah, and I can tell that how. Well, one, you go look at the listing services, it's not there.
Yep.
They don't
Mhm.
have the information. Two, it's they reference in the notes a
Yep.
certain attorney, a certain title company. And I'm like, this is very interesting. And that's a huge more than 50%. I mean, that's wild. So I think that there isn't your alternative market is
Yeah.
out there, and people don't. I think that that's also part of why people don't really understand what's happening, is because it
Yeah.
all happens without being tracked,
Yeah.
so we don't actually know what's happening.
And
All
we've
kinds
been
of
getting
stuff under the
feedback.
radar. Mhm.
Those people who watch our show and listen to our show a lot of times are small people in different markets, right?
Right.
But what we're finding out is that those small people, as a collective sum, have a great understanding of the local area more than the banks, and a
Absolutely.
lot of times more than the
Oh
servicers,
yeah.
because they have boots on the ground. They see the fact that houses are
Correct.
sitting forever.
Yeah.
They see the abandoned properties. They know their culture a lot better. So, guys, if you're listening or watching this, you know, you're one piece of a puzzle that's really important.
Correct.
So give as much information about your local market as you possibly can. Put in the chat or on the social media platforms, and just let people know that what you're seeing locally, because that's
Mhm.
extremely important. If you're seeing great times and saying, I don't know what Melody's talking about, things are great. There are
Right.
pockets that are doing wonderful, right?
Right.
And when we get that local information, I mean, we saw this. This was portrayed really well in Big Short, where they fly out to California
Right.
or to Florida, and then
Florida.
start looking around, and they're like, "Oh my goodness, this is not
Yeah.
exactly what's been
Right.
reported." And that we see that same thing when we get together in our groups and talk and discuss what's going on in your local market. It's not always what's being reported in mainstream.
Which is why I drove over 10,000 miles
Yes,
to all these
exactly. Yeah.
markets, and saw what they wrote about in the Wall Street Journal and Bloomberg 2 weeks ago about the builders. I saw that in 2023.
Yeah.
Was talking to
Yeah.
reporters then, so I totally agree with you. And let me tell you, from boots on the ground, I was at a conference in Dallas. This is I think I told you about it, Nate. It's called Five Star. It's a
Mhm.
conference for people in default, and heard from the person, the rep from Equator, that short sales were just exploding everywhere. So she was
Wow.
telling everybody, this was like an REO group, right? Real estate owned. She was telling
Mhm.
everybody, you guys need to know how to do short sales.
Yep.
And now that's just, so I had heard that from just a couple people I knew from the industry, like smaller players, but to hear her, the
Yeah.
person, and if you don't know what Equator is, like it's the largest REO system that people use out there. Hearing her say that, because what have we been told for 5 years? There's nobody underwater, right? Like,
Yeah.
Yeah.
like overnight, 2 weeks ago, 900,000 people are underwater. I was like, wait a minute,
Whoa.
you guys said nobody was like,
Yeah.
and
Yeah.
That
so
rolls equity.
right, where's all, and then my friend John Comiskey that
Yep.
he's looking at all these FHA builder loans that are underwater. I went to the neighborhood out in Texas where that was happening, empty new builds, of course. So those people are probably going to be looking at really reduced values here in the near future. I mean, it's just sad, and so I really feel our media has done a real disservice to the American people, in my opinion, because I think a lot of people made decisions that they probably wouldn't have if the media wasn't running around saying some of these things, like there's an inventory shortage. So anyway.
Yeah. Is there any markets out there that you're seeing that's significantly doing, well, where it's like, man, you said Rochester is one of them. And what do you think's prepping those industries up? Is it, Walmart pulling in next door? Is it a large company coming in? Um,
Manufacturing
Well,
job, something.
yeah, what's scary about that Rochester area, and so when I say better, like it's so don't go by there, because what's happening is they have a buy the block program where, because they have so much vacancy, the investors are going in and buying up blocks and things like
Mhm.
that.
Okay.
wow.
But the promise of Rochester was going to be that Micron plant that was in adjacent, like it wasn't even in the same town. Like I still don't understand it, because I did a deep dive on Rochester and how all industry had left, but they want to be kind of this tech hub. I've heard that about 5 cities across the country, but what's happening now is all the investors that went in and
Yeah.
bought properties based on that Micron story are now
Mm.
selling, which is why it looks like it's transacting fact. So you always have to be careful. And Micron just came out and said they were delaying that plant by 2 to 3 years, which always happens. And so
Yeah.
a city gets sold on a narrative, the investors follow,
Of
and
course.
then you get into trouble. So I just quickly looked
Mm.
at, so like I said, San Francisco looks hot right now from a year over year perspective, but they're down, their prices are down. Honolulu, we know that it looks hot, but we can tell you the inventory has absolutely exploded, and
Wow.
prices are down. And I mean, Hawaii is in a lot of trouble right now. So I think most of the story is that if there's transactions, it's because they're motivated or distressed right now.
I've seen a lot where municipalities in particular are changing the rules on Airbnbs.
Hmm.
And so then
Yep,
all these Airbnb owners are
that's
like,
correct.
well, shoot, I'm out. And then so they start selling.
They started
That's
And
correct.
rental. They started doing long-term rentals, but the long-term rentals do not equal what the Airbnb
Oh,
income
not
level
even
is.
close. I
yeah,
mean, it probably may equal, but not what they were told it would equal
Yeah.
yeah,
by AirDNA, who said
Yeah.
they could get,
Yeah.
10,000 a month
yeah.
AirDNA.
in
Yeah.
Kyle, Texas.
So
Yeah.
one thing came up recently, and unfortunately Nathan and I weren't able to attend, was an expo that was ran and talked about AI. What have you been
Mhm.
hearing about AI? And we've heard some whispers we'll bring up in a second. But what are you hearing from the bigger players that are using? Are they using AI? Are they doing tools with
How are they
AI?
using it?
And how
Yeah.
are they using it? It's-
Yeah, so I have a bias of, I trained large language models. I tried, what I always came up against in fintech is nobody really wanted to do the work to make it happen. They would start with a technology project and end with a room full of Indians, like doing the work and
Yeah.
and often lying to the client. These were things I found out not because I was told. So listen, there is limited use case for AI. There is, but it is not what everybody says that it is. And anybody that's trying to use it, like MIT, I think came out with that story and said, it's like 95% of people that are using it aren't seeing any productivity gains. And so as someone who played around with coding in my life before, you also know my biggest excitement on AI was around coding because I thought, oh, you could code something really quickly. The problem is, as a coder, you will look at the code and it won't be working, but then you have to figure out what did it do, and that takes
Mhm.
twice as long as if you had written the code. So how are people using it? I don't know that they really are. I think
I was
that,
more, we had a whole show
go
on it
ahead.
because I do a lot of coding. I was never a coder except for back in the day in high school. And I use it just to code and do certain Python scripts and things like that on a daily basis. And for me to dive into a code, I don't know what I'm looking at for the most part, but I'll say, here's my error in here. And I run about 15, 20 Python scripts a day on a repeated basis, which is great. But what I was curious about when it was brought up was using blockchain and AI tools with that. Have you heard anything about that from your level of blockchain being used to record mortgage documents and things like that?
Oh, they won't ever do it. I tried really, really hard. And then I finally met the person that put the kibosh on it in the industry because he worked for the largest technology provider in the industry. And he told them, if you use blockchain, you will put yourself out of business.
Mhm. Hmm.
That is
So they
true.
Yeah,
don't
we're
want. Yeah,
and that's
I wanted to do it for Ginnie Mae repurchases. I wanted to do it for Ginnie Mae settlement. It would make so much
Yes.
sense
So
for
much easier.
recording mortgages, for all of that stuff. But and this is part of my thing, Dave. It's like, it helps individuals, sure, but
Sure.
the companies can't or won't adopt it
Yep.
for a variety of reasons.
Yes.
And that is
Mm,
what I came up against
mm,
throughout my entire time in mortgage fintech. I was a believer, and I do still believe in certain aspects of the technology, but the industry either can't or won't. And a
So I
lot of
agree
it's
with you.
won't.
I think the red
Yeah.
tape is what's
yeah,
blocking a lot of it from
yeah.
progressing. It's like, whoa, whoa, whoa,
Yeah.
we can't do it. And even government in general, they're way behind at times. So I think that those who are using it are going to benefit from it tremendously. But those who are holding back from it,
Smartly. Yeah.
yes,
Yeah.
those holding back from it are going to fail. I mean, I think that's going to be the new upbringing that maybe these big companies are going to be passed by someone smaller because they're doing it. But the problem is you can't do recording documents if partials on a blockchain and some aren't. That's
Right.
frustrating,
And
right?
and and I think too, I think it's also though being used as a ruse, meaning that I don't necessarily, I think these companies are going to fail, not because they adopt AI. Like if we're talking about
Yeah.
mortgage specifically, it's not going to be whether they adopt AI. And in fact, I think the biggest adopter is probably going to fail. I think that we're using that as a smokescreen for an economy that has been really not great for most Americans for a very long time.
Mm,
And we're also looking at a model that needs to go away. Non-banks should not be lending. They don't have deposits. They don't have deposits. And this is where I think, you guys come in because I'm really at the point now where I just don't think we can Henry Ford credit. I don't, like everybody has tried, they've
yeah.
tried. And they've tried with these automated underwriting models. And what I'm seeing on the other side of that is just, it's horrible.
Yeah.
And so, I mean, what you guys are doing is actually assessing credit worthiness.
Yeah.
Whereas I think that the lending industry has gotten far away from that. But tell me what you think about that.
Yeah.
That's a great point. Because so I went to a mortgage AI conference of month and a half ago, and as far as on the origination side, what they were saying they're using it for, and I agree with it to a point, but they're using it for helping people fill out the documents.
Mhm.
So like the 1003 application. So
Right.
they send it, they've got this little chat bot person that says, now I need this, now I need that. And then they send in all the documents and everything else. I think that's a great use for it because once that's all done, now they send it to a human who can fill in the
Mhm.
blanks and say,
Right.
okay, this is why this is a good deal or not a good deal for this borrower
Right.
because, and all
Right.
the extra things that a computer is not going to be able to analyze properly.
Right.
So and if it goes that direction, I think that can increase efficiency a lot. But again, it always comes back to that human that has to make that final decision. It
100%.
should, in my opinion. But anyway, yeah,
Absolutely, because what if, like, so
Yeah.
AI, so firstly, it won't be able to say, oh, that's a fake paycheck stub. Like,
right.
like we do smudge tests. Like you have to do physical things sometimes to And then also it's easy to hallucinate. Oh, he
Yeah.
works at General Electric and makes $500,000,
Yeah.
so
Yeah. Yeah.
and again, I think limited use cases where you have an awesome model, but guys, what it takes to keep those models, those large language models running, they get off the rails at a second's notice because the more input comes in, the more their brains just start to fritz out and
Yeah.
more training that is required.
Mhm.
It's a lot of effort. It's a lot of effort to keep these things running.
Yeah.
And I tried all that stuff, Nate. I was building a
Mm.
underwriting tool. I was building a document gathering. I mean, I've got a product graveyard you would not believe because I wanted the efficiency. I
Yeah.
thought there were ways that we could do things, but I've now realized like the folks that are going to use it are going to probably use it poorly because
Interesting. Yeah.
you absolutely need that human underwriter looking at, and this is where AUS went completely awry in my opinion, because
Mhm.
every lender was like, well, I don't have to take any responsibility for this. I mean,
Yeah.
AUS says prove, so
So
Mm.
we're talking to some of the servicers, and the biggest default right now by far has been wrap notes. Wrap
mm,
notes, and there's more and more being created. Um, I'm sure you're
And
not
that's been
seeing it at a
true.
bigger
Like
level.
he was going back like 6 to 8 months.
Yeah.
And we talked to a couple of different servicers and they said the same thing. Those wrap notes are the ones that are defaulting in large measure.
I
Yeah.
just can't even believe we're talking about them. So I mean, it makes me want to go back and study the 80s more and what happened because I think there was a lot of that then, I'm not as familiar with that cycle. But anyway,
Yeah.
yeah, I think we're in the transition time. And so everything's going to look very confusing for a little while. But I think, like you guys both said, look local. That's going to tell you what you need to know. And then together as a sum, it's going to give you a much better national picture of what's going on. But boots on the ground these days is just absolutely critical, in my opinion. Because, like, let's say you were thinking of buying a house in California or somewhere like if you just started driving around, you would be like, why is all this property vacant? Like,
Yeah.
what's,
Mhm.
and maybe there's not a for sale sign, but it's going to give you an indication that there's something not exactly right in that market. And the worst thing about a market like California and those big areas is the low owner occupancy, right?
Yeah.
And
Mhm.
so we know that boomers own the majority of the homes, and they own a lot of the investment properties. And so there's so much rental, in places like LA, places like that, but those are owned by people that will be for sellers
Mhm.
in the near future.
Are
And
you,
Yeah.
so,
are you running rental numbers? Are you seeing rental numbers going up or down, or where are they at?
in terms of inventory,
No,
it's,
of
oh,
cost. Like,
yeah.
are you seeing them going up still? Because for years we've been seeing them constantly going up, where it's unaffordable still.
Well, so, and that's a great question. And here's some good food for thought. So, October apartment list came out and said, boom, largest decline in a month they'd seen, blah, blah, blah. I can't even keep up with these stats anymore, but go, Google it, you'll see.
Yeah.
But the second thing, where rent is going up the most is Chicago. Why is rent going up the most in Chicago? Because they gave non foreign born $15,000 for their
Mhm.
rent and a subsidy.
Mhm.
Okay. They just stopped those programs. And so, what you have in a lot of these cities where rent is going up is false demand through subsidies to our immigrant population. Places like, Portland did programs where you get $30,000 as a down payment only for foreign born.
Wow.
So this is a story that people we can't understand how much it's impacted
Yeah.
the housing market yet. We will, like, John Burns just came out and showed, even though everybody said it wasn't happening, lending to immigrants, it was 6% of FHA until it stopped. And so it's this has a big impact, like New York. Okay, what's going on there? Well, they were housing illegals in hotel rooms. And so hotel rooms are crazy expensive.
Sure.
And then you also have the thing where 50,000 or more, I've heard up to 100,000 of those rent stabilized apartments are being held off market because they can't, since that 2019 law, they can't raise rent enough to cover the repairs they need for zoning and requirements. And so each market has a story,
Yeah.
but there's a lot of false demand because of these government programs that are running out. And so, I think just and the inventory, like, because what the point you said, Dave, is so important. It's like when they can't do the short-term rental, they're going to try to do the long-term rental. And so in all of these areas where you have 20% inventory increase year over year, you also have similar numbers on your rental inventory. And so it takes a lot of time for these things to play out. And when you have things like the government doing a crazy loss mitigation program, it really slows it down, and makes it really confusing.
Amazing.
So
My brain's hurting from this stat you
I'm
given us
sorry.
last
No
little
kidding.
bit.
I know.
But I can't say anything you said isn't something valuable to be heard. And I think people either ignore it or they don't think it's important or it's not affecting me today. So I'm not really, or my local market, right?
Right.
And that's the problem, right? This happened 05, 06. It didn't happen here, it didn't happen here, and all of a sudden happened everywhere. And that's
Exactly.
Yeah.
it spreads. Well,
Yes.
It's going to be a very interesting time. And like I say, that our challenge then is to look for ways that we can help and different kind of opportunities that could be presented there. So
so
interesting.
we're gonna put you in the hot seat again.
Yeah. Yeah. What do you see? So, I mean, we've talked about all kinds of different things, but if you could give us
I know you don't like doing this, right?
Yeah, I
the
know.
thing you don't
Yeah.
like to do, but where do you see in the next, let's call it 12 months?
Yeah, so I think we'll end the year probably flat.
Mhm.
Case Schiller is very interesting to watch right now. Non-seasonally, it's coming in negative month over month. But so home prices, I think, will end flat. I hope we kind of get sales just up a little bit year over year, and that's what it's looking like right now. It looks like we are picking up steam.
Mhm.
Now, 1 month is not a trend, but we'll see. But next year, I just don't see how we don't see price corrections. Because what you're seeing right now, and like I physically look, I could use a script, but I physically look at these markets each week, and I
Mhm.
can tell you that price cuts are accelerating. They're just not; those homes aren't being sold. And until those homes get sold, we're not going to see those price cuts. But I think you're going to see more short sales.
Mm.
I think you're going to see more REO. I think you're going to see
Mhm.
more delinquency from here. And you're going to see a lot more abandoned property.
So
And so,
guys, put your money in your pocket and keep it
Yeah.
there, right?
correct.
We've talked about the last couple of weeks. People who are buying assets and stuff like that. Please, if you're seeing a lot of people bragging about buying, don't get too envious. You don't know what the other side looks like. You don't know if they bought bad or good or if they're, the future, what's going to happen to that market. So just be careful, do your own due diligence, do your own business,
Correct.
and don't be jealous of anyone. We hear a lot of, oh, that person bought 5 assets. It doesn't mean you should or shouldn't. Just
Yeah.
means the fact that they did that. So Melody, it is always a
Very
pleasure
interesting.
to have you with us and spend the time.
Mhm.
The other world is such a unique feature, and I'm sure our world is probably just as interesting to you um, in what we're seeing on the small micro market of the big mortgage thing. But we'll definitely have you back just to get a snippet of what's happening and how we're doing, what's going on in the market, and a global idea of where we're going. And that's such an
Mhm.
interesting roller coaster we're on, that we
Yeah.
are in this. And the funny thing, we all complain about this, but I still see us doing this 5, 10, 15 years later, just because we love the space as much as we do.
Yeah.
Right.
Yeah.
Awesome.
Yeah. Great to have you. Thank you.
Thank you so much for coming on
Thank
and spending
you.
some time with us. We will talk soon. Hang out for after hours. To everyone else, we will see you soon. Take care, everyone.